Every February, Warren Buffett writes a letter. No earnings call fluff. No investor relations spin. Just one of the greatest investors alive, talking directly to you. And the 2024 letter? It might be his most personal, and most important, yet. In this video, I'm breaking down the entire letter, every key insight, every hidden lesson, and what it actually means for your money. I'm Aiken, and if you're serious about investing, the next 10 minutes could be the most valuable thing you watch all year. Let's go. Buffett opens the letter with something unusual for him: humility. He openly admits that most of our businesses will report lower earnings in 2024 than in 2023. Now, that alone should stop you. Because Warren Buffett doesn't apologize. He explains. And what he explains here is crucial. He says the exceptional tailwinds of the post-COVID economy are gone. Inflation ate into margins. Higher interest rates changed the game. And the businesses that looked extraordinary in 2021 and 2022, many are now returning to normal. The lesson? Reversion to the mean is real, even for Buffett. Don't confuse a great business environment with a great business. Understand what's driving the earnings, because if it's temporary, the earnings are too. Buffett has been saying this for decades. But in 2024, he's living it with his own portfolio. Let's talk about what Buffett actually owns and what he's proud of. He dedicates significant space to two pillars of Berkshire, BNSF Railway and Berkshire Hathaway Energy. On BNSF, Buffett calls it one of the most important businesses in America. And he means it literally. Moving freight by rail is 3x more fuel efficient than by truck. As America's infrastructure ages and supply chains evolve, whoever moves goods wins. But BNSF had a rough 2024. Earnings dropped versus prior years. Buffett doesn't hide it. He cites a combination of labor cost increases, operational inefficiencies, and rate competition. Here's the key line: he's not selling. Because great investors don't sell great businesses because of one bad year. They ask, is the competitive moat still intact? On Berkshire Hathaway Energy, this is where it gets interesting. Buffett is navigating wildfire liabilities in utility businesses. He's publicly wrestling with whether utility regulation in America is broken, saying the current framework puts companies in an unfair risk position. This is rare honesty from a CEO. And it signals why BHE's future is more uncertain than BNSF's. Okay. Let's talk about Apple. This was the headline of the letter. Buffett reduced Berkshire's Apple stake significantly, trimming from roughly 5.9% ownership to under 3%. Why? He gives a few clues. First, taxes. Buffett flat out says he expects capital gains tax rates to go higher in the coming years. Selling now, at current rates, was a tax optimization move, not a rejection of Apple as a business. Second, position sizing. Apple had grown to represent nearly 50% of Berkshire's equity portfolio. Even if you love a stock, that's a concentration risk Buffett decided to reduce. And third, read between the lines, Buffett still calls Apple a better business than any we own. He's not bearish. He's just being a disciplined portfolio manager. The lesson: even your highest conviction positions need to be right-sized. Selling doesn't mean you're wrong. It means you're thinking long-term. Here's a number that should make your jaw drop: $168 billion in cash and T-bills. Berkshire is sitting on the largest cash pile in its history. And Buffett addresses the elephant in the room directly. Why aren't you deploying it? His answer is patient and almost philosophical. He says, we only swing at pitches we like. In a market where valuations are stretched, where quality companies are priced for perfection, Buffett refuses to overpay. He'd rather earn 5% on T-bills and wait for a fat pitch than buy an overpriced business just to feel active. This is the discipline that separates generational investors from average ones. The takeaway for you: cash is not a dead position. Cash is optionality. When the market corrects, Buffett will be ready. Will you? This section of the letter is unlike anything Buffett has written before. Charlie Munger, Buffett's partner, mentor, and closest friend, passed away in November 2023. And in this letter, Buffett pays tribute in a way that will genuinely move you. He writes that Charlie was the architect of Berkshire. That while Buffett ran it, it was Charlie's vision and mental models that shaped the company into what it is today. Buffett says, Berkshire could not have been built to its present status without Charlie's inspiration, wisdom, and participation. This is not corporate language. This is grief, and respect, and love, poured into a shareholder letter. The lesson here isn't financial. It's about finding the right partner. Buffett is arguably the greatest investor ever. And he attributes enormous credit to someone else. Humility, partnership, and lifelong learning, those are Buffett's real competitive advantages. Buffett is 94 years old. The letter doesn't dance around this. He reaffirms that Greg Abel, Berkshire's vice chairman of non-insurance operations, is his chosen successor. And he says something important: Greg thinks like an owner, not a manager. That distinction matters enormously in how a company is run. He also reiterates that Berkshire's culture, the decentralized ownership model, the long-term thinking, the aversion to bureaucracy, is designed to survive beyond any one person. Buffett essentially says, "We've built a machine that doesn't need me." For investors, this is reassuring. But it also raises a real question: will Berkshire in the Greg Abel era be as aggressive about capital deployment? Will the culture hold? Nobody knows. But the structure is there. And that's intentional. Near the end of the letter, Buffett does what he does every year, reminds us of the basics. But the basics are worth repeating. Point 1. America wins long term. Buffett is unapologetically bullish on the U.S. economy over decades. He's seen 14 presidents, 8 recessions, a pandemic, and multiple crashes. He says the country's economic engine, combined with American ingenuity and rule of law, makes long-term equity investing a near certainty for good outcomes. Point 2. Don't bet against compounding. Berkshire's per-share book value has grown from $19 to over $600,000 since 1965. That's the power of compounding, uninterrupted, patient, and boring. Point 3. Temperament beats intelligence. Buffett's edge was never just his IQ. It was his ability to stay calm when others panic, and disciplined when others get greedy. These lessons aren't new. But in a world of meme stocks, crypto hype, and 15-second trading tips, they're more needed than ever. So let's wrap this up. What did we actually learn from Buffett's 2024 letter? White heavy checkmark: even the best businesses face mean reversion. Understand why earnings are up before celebrating. White heavy checkmark: cash is optionality. Don't be afraid to hold it while waiting for the right pitch. White heavy checkmark: selling a great stock isn't always bearish. It can be brilliant tax and risk management. White heavy checkmark: your partner matters more than your strategy. Find your Charlie Munger. White heavy checkmark: long-term thinking beats short-term noise, always. Buffett writes one letter a year. I think you should read all of them. But if you're starting anywhere, start with 2024. It's honest, personal, and packed with timeless wisdom wrapped in current context. If you found this breakdown valuable, smash that like button, subscribe, and drop in the comments, what was your biggest takeaway from the letter? And if you want me to break down Buffett's previous letters, from 2023 all the way back to the classics, let me know below. I read them so you don't have to. See you in the next one. Money bag.